I've got an excellent tutorial for you today. This is part 5 of our How to Read a 10K tutorial series. This one's going to go over the cash flow statement. Admittedly, the cash flow statement is probably one of the most complicated of the three. I mean, the balance sheet's really straightforward. You have assets and liabilities and equity. Income statement's really simple too, right? You have cash coming in, revenue, and then how much profit did you make from that revenue, and what are the dividends coming out, and what's the growth out of that. So those are really simple. Once you get into the cash flow statement, that becomes a lot less clear. So it starts to talk about like what a company does after, what they do with their profits, where that cash goes. And it can get complicated because it's trying to more accurately reflect what's going on with the actual cash. And that can change. So basically, they might record a profit for 2017 or a revenue for 2017, but not actually get that cash on the books, like in their accounts, however they hold that cash until 2018, or it might get into their account 2016, something like that. So the timing on it can be a little bit off. I'll also show you how to calculate the price to cash ratio, and there's a lot of discrepancies about calculating that, so I'm going to go over that too. Just for starters, just because I'm not feeling super creative today, and I don't know which stock we should look at, so let's just randomly take one that has like a good price to cash. Then maybe maybe it will have, let's take Ford. That sounds like fun. So I'm going to show you Ford's cash flow statement. We'll go through, try to define some of it, and then at the end we'll calculate the price to cash, which, as I'm sure you know, it's quite simple. Price to book, price to earnings, price to sales. Those are all very simple ratios. And the hard part's looking through the 10K statement and figuring out where those values are, because as you can see, this is like over 100 pages, right? Real quick, I don't believe I mentioned this before, but the reason why I write down consolidated balance sheet versus like consolidated income statement or consolidated cash flow is because a lot of times, just like I always say, a lot of financial reports, a lot of annual reports have differences in how they title things, how they format things. And I very rarely see a difference in, almost everybody writes down consolidated balance sheet, but there'll be like consolidated income statement, and then there'll be like consolidated statement of income. So it's like, come on, dudes, like, can't you all say it the same way? I think the one time I saw it was different was like consolidated financial position. I think that was Hormel or something, but most everybody else says consolidated balance sheet. And so when I search it, then I can find it. And then usually, all three statements are right next to each other, so you can find them super, super simply. All right. So I'm going to kind of show you some of these things. Oh, and I love how they go 2015 to 2017 left to right instead of, doing it the other way, right to left. That's annoying as well. Okay. So I'm going to show you some of these. Another thing the cash flow statement's really good at is helping you figure out operating income. I did a video just the other day about owner's earnings and how Warren Buffett uses owner's earnings. So you have to use the cash flow statement to calculate that formula. So that's where it can be very useful. So you can start to see differences between like how a company might make earnings from their operating stuff, which is basically the core business, versus like investing, financing. Sometimes they're like one hit type things that, like the perfect example, the tax reform that we recently had affected lots of corporations, obviously, and it gave like a one-time hit, or either a one-time hit or one-time bump to earnings for a lot of different companies. And, that's not what's going on in the actual core of the business. That's something that was outside of the core of the business. And so sometimes you can use the cash flow statement in addition to the income statement. You can kind of interleave the two to sometimes figure out what the differences there were. So right here at the very top, net income, that's going to be the same net income that they report here. So you can see 73.71. So they're actually reporting what's attributable to the Ford Motor Company and not what's attributable. All right, no, yeah, it's right here. Net income. So I hate this stuff, but when they have two different net incomes, looks like it's probably better to use the one that's showing up in the cash flow statement. Because if the company's, attributable, it's talking about stuff in Wall Street and like stuff to do with the various shares. But I would just go with this net income number. Again, you can look, it's barely a difference. It's not going to mean anything in the grand scheme of things, but let's just be specific for the sake of it. Depreciation and amortization. All right, well, this is as good a place as any to talk about what that means and how it impacts business, right? So depreciation. So say you have like a big plant that you need to buy. So for Ford, they do cars, right? So they're going to want to build manufacturing plants that are automated with machines that can put these cars together. Now, when let's say a plant is, I don't know, I mean, maybe we can even see, they might actually report what they depreciated, and that would be helpful and help me kind of teach you what this is. Would be helpful in the sense of doing this fake kind of analysis. So like, for example, inventory is an asset. Hope that's obvious. Because when you sell inventory, you can make profits. So the cars depreciate, and so that's taken onto there. So like if inventory is just sitting on the lot, it's losing value, right? Okay, so maybe it's not useful for me to find an exact example, but let's say, because vehicles, like I'm looking for a big expense asset that really adds a lot of depreciation, because that's a really easy way to understand how depreciation works. Okay, so basically, say we have a plant, right, and it's going to cost us, I don't know, $10 billion to build. And in the case of Ford, they made $7 billion last year. So if we were to record that and the income statement, it would say, well, you made $7 billion, but you spent $10 billion on the plant, so you really lost $3 billion. That's true. That's what's happening with the cash flow, right? You would assume that they have more cash in their balance to kind of pay the difference. But as far as like figuring out, well, what exactly happened in 2017, that's going to throw everything off, right? And now we don't know what happened in 2017 because they could have had a great year compared to 2016 or 2015, but because we have this huge expense for the plant, makes our year look like we did awful, when in reality that's going to be good for the company, because now they can make, let's say, 100,000 more vehicles with this new factory. And so, the business is growing and the year was actually good, but this one investment makes it look bad. So then that's where depreciation comes in. That's where depreciation and amortization come in. And they basically, if it's like a factory, and let's say we know that the factory is useful and able to produce for 10 years, then they'll depreciate it over 10 years. And so the cost, instead of being all put on 2017. They'll be from 2017 to 2027. And then they'll just remember in our example, I said $10 billion. So we'll depreciate $1 billion every year from 2017 to 2027. And now we'll know what 2017's real, core operating business, how it did. And now we can compare it to last year and not have to really factor in the whole one-time special expense. Amortization is similar. Excuse me. So in order to understand that, we need to understand the balance sheet and goodwill. So if we go back, and I really need to get a microphone with a boom stand so that I'm not constantly putting it up and down. I'm going to have to keep putting it down every time I want to type. So balance sheet, obviously not going to get too in depth into it, but you have assets, liabilities, and assets. Part of what makes up assets is also there are things in business that aren't what they call tangible, or they aren't quantitative. You can't assign a number value to them, but they are valuable. So for example, with Ford, they have the factories, and obviously the more factories they have, the more inventory they have, the more earnings they can create. But also they have the Ford brand, right? So you might argue, I've had a Ford before. Found on road daily is an acronym that they say. But it's all difference of opinion. You could love the Ford F-150s, right? Those are known as great trucks compared to like a Chevy, and you have a big fan base behind those. So there's value in the Ford brand and the F-150 brand, but you can't put a numerical number on that value. But there is sales happening specifically because it's F-150. So what they try to do in the finance world, in the financial statements, in the accounting world, is they'll put like goodwill and intangible assets, and they'll put those things inside a balance sheet. So I don't know why I'm having trouble finding where their goodwill is on their balance sheet. I'm sure we could search for it. See, this section, net intangible assets and goodwill. So what they're talking about is how they don't amortize their goodwill. So now to explain amortization, say that in some crazy world, Chevy bought Ford, right? And Ford, with their accountants, they calculated that this is before the purchase. Ford had always said, well, our goodwill, basically the power of our brand is worth, let's say, $40 billion. And let's say, okay, that's not the best example. I'll explain why. So let's say Ford has a patent on this new electric car, because we're talking about intangible assets, right? So a brand power and popularity of a brand definitely falls under intangible assets and goodwill. And so does like a patent. So let's say they have a patent on an electric vehicle that's 10 times more efficient than every other vehicle in the market. And so let's say that patent has a value. That patent is basically applicable for 5 years. So nobody can compete with them for 5 years. And after that patent's out, then everybody can build these electric vehicles just like Ford is. So they're going to dominate the electric vehicle market for 5 years because of this patent. So the accountants will probably rate that piece of goodwill, that net intangible asset, pretty high. Now let's take the example where Chevy buys Ford. So now Chevy gets all of Ford's assets, all of their factories, all of their inventory, all of their cash, all that stuff, right? They will also get that patent. And so what you do with the patent and the goodwill is the exact same thing that you will do with the depreciation. So whereas, it's kind of a similar concept, right? So for depreciation, it's a huge expense, right? And you don't want to muck up the most recent year financials. You want to know what's a more accurate picture of what the core business and how it's performing. So for Goodwill, it's the same thing. Our patents is valid for 5 years. So if we were to just throw the whole thing in our financial statements now, then all of a sudden we're going to have a huge bump in net assets and shareholders' equity, book value. It's going to make the business look a lot more valuable than it really is, and it makes it look like we had a huge growth in assets in 1 year, when in reality, this is a patent that's going to be useful for 5 years. So they amortize it and they divide it up again by 5 years. And so that's why I was saying brand power isn't necessarily a good example of that, because brand power, kind of like what they're saying here, it's indefinite, right? Because F-150 brand. So they will test it. Looks like they test it annually. So basically they'll see, is it getting less popular? Then we need to mark down on the balance sheet that our Goodwill and our brand power is less valuable. So they do that, but they don't amortize it because there's no time period. Whereas like a patent might be 5 years, and they can amortize that over that 5 year time period. So hopefully that all makes sense. And so really you see amortization in like a patent sense, and you also see it when you get acquired. So they usually do all of the Goodwill amortize because they don't want that acquisition to make the core business results look better than they actually were. Undoubtedly, you can't really avoid that, right, to some extent, but they try to minimize it as much as they can to make, and that's what all this stuff is. It's all an attempt to be as accurate as you can be. And so obviously I haven't been in the trenches. I don't do this. I'm not an accountant, and I don't do business account stuff, but I know it is like a thing that they're just trying to be as accurate as possible. That's why you'll see FASB, the accounting board, they're always trying to make it better, and they're striving for accuracy as close as it can be, but nothing's perfect. So that's depreciation, that's amortization, that's other amortization. So now how this kind of reflects in a cash flow statement is that, going back to our example, right? And this is where income statement and cash flow statement can be different, and it can be sort of confusing. So I'll try to break that down. So let's say, I'm giving you so many examples, and I hope they're helpful. I hope you're following. So like, let's say 2015 was the big year where they bought a new factory, right? So let's say in the cash flow, they already took out all of their cash, and they built the factory, and now their cash balance is now tapped, right? Basically, they spent the cash. Okay, I don't know why it's so hard for my brain to say that. They spent the cash. Now we know for the next 10 years they're going to depreciate the rest of it. So, for 2016, they're going to have a net income that's less because of the depreciation, but their actual cash in the bank will be more because they're not spending that money. It was already spent. Their cash balance is already done. And so that's why in the cash flow statement they add depreciation and amortization, is because in the net income number, the money's spent because we average it over 10 years. But in reality, it was spent in 2015. And in reality, they didn't spend whatever that depreciation amount was. And so what they have in their cash balance is actually more than what their profit net income is reporting. I hope that's sort of clear as well. It becomes confusing when you're looking at the cash flow statement, because now of course they've got a bunch of factories, they've got a bunch of inventory, they've got a bunch of moving parts, and so the depreciation is not staying constant, and so that can make it difficult for us. But the big thing is just remember that that's why in the cash flow statement we're what we have as cash is usually more than what we earned in net income, as profit, reported as profit, because the cash was spent previously, and we're not spending any cash even in 2017, even though we're depreciating it over that 10-year period. So the profit's lower because we didn't want to kill profits in 2015. We're spreading out that expense over 10 years. So that's why it gets added back into here. And then there's some other stuff. Try not to get into this too much, but some of this can be. So I showed yesterday on was it yesterday or 2 days ago on the Warren Buffett video with owner's earnings, but non-cash charges, employee benefits and stuff. So this is stuff that they have to book because they are expenses, but not necessarily making a difference on the net income. So basically what's going on in the cash flow statement is anything that's indirectly or directly contributing to the final balance, the final bank balance, right? What's going on in let's say they have a business checking account. I don't know how public corporations keep their cash, but let's just pretend it's one huge bank account with a business bank account, Bank of America. And so at the very end, maybe we should have started here, but let's go here now. So this is what's going on in the business bank account. This is what their business bank account is at the end of the year, December 31st. This is the bank account at the beginning of the year. So everything that's going on here is reporting on what's going on in the bank account. Why did it change over the year? Well, that's what the cash flow statement's trying to tell us. And so why is that problematic? Why is it different from what's in the income statement? Is because, again, perfect example, the depreciation and building, buying building assets, depreciating it over many years, is because, remember, we could spend all the cash in 2015, but in the profit sense, we're not going to take the expense out just in 2015. We're going to spread it out over 10 years. And so there's a lot of those sorts of factors that go into it, and that's what the cash flow statement tries to explain to us. And so there's going to be a lot of little things, and the reason why I don't want to get into every single line item is because it's literally going to be different for almost every business. And the big things are the ones that we want to really cover, like depreciation, amortization. Every business has to report that, right? As far as non-cash charges go, the way they're going to compensate employees and things of that nature, stock compensation, that's a big one here. I don't know if you can see. I'll try to highlight it. So that's like a major one that kind of every business has to report. So in this case, right, well, why is this adding to our cash? Because for stock compensation, you have to remember that with stock options, a lot of times employees have to wait for it to vest, right? So this is a tool that corporations use to try to keep people from jumping ship and incentivize them to stay around longer. So they pay them less so people don't jump ship and then come back and they can give them minimum raises, right? Not to be too pessimistic or jaded, but that's the way it works, folks. So with compensation, if a bunch of employees' stocks haven't vested yet, they will eventually probably vest, and so you still have to account for it as an expense. And so like up here, they're accounting for it because that's just like wages, right? You have to account for how many wages you paid out in the year. You also have to account for how many stock options you gave out. But, they haven't maybe vested in this year. So that's where stock compensation comes in. And that's why I hope with enough of these examples, you can understand why we're plus and minusing. But basically, you're adding stock compensation to what we reported as profits because we actually, as a company, never paid what was owed to these employees because they haven't invested. So we actually we had more in our cash bank balance than what our profits state because it states as an expense, but we never paid it out. So we're going to add it to our cash flow statement. This stuff, and you may have to save this for later in your save later playlist for YouTube. You might have to go back and rewatch it again. You might have to watch some related videos like the Warren Buffett video and see how I navigate the cash flow statement in there. in order to understand these concepts, because I definitely didn't understand it right away. That's why, when I did the balance sheet and the income statement, the hard part was really navigating through and getting to the 10K. But, the easy part's understanding, well, assets are easy. I know what an asset is. I know what profit is. I know what revenue is. But the cash flow statement's really confusing. It took me a long time, and I'm probably still not like 100% on everything in the cash flow statement. So don't be discouraged, but hopefully this tutorial is massively helpful for you to start to get a grasp of what's going on in here. And remember, at the end, I'm going to show you what I use when I'm analyzing stocks for my value chart indicator, what I take out, what I pull out from the cash flow statement, and how I use that to analyze a stock. All right, so that's going to be some other things. They also talk about changes in working capital. Again, I cover that in the Warren Buffett video. Warren Buffett formula for FANG stocks, that was the one. But basically, it's a lot of similarities. You have inventory decreasing or increasing. And so, if you're having an increase in inventory, you're going to have to pay cash to basically buy more inventory, right? For this inventory, in this case, because increase is in parentheses and it's a negative, that means they're spending cash to get more inventory. And so it looks like it's a negative. That means they spent 1.1 billion in cash to add to their inventory. And so that's why they're going to account for what the change in the inventory was. So if you go up here, what's nice about the cash flow statement, I guess, is a lot of the stuff that's in here, you'll also see it up here. So that can kind of help you understand it sometimes. So if you look at their inventory, it's going to be current assets in the balance sheet. So here's their inventories. So you can see they increased it by, and I have to remember, right? 2017 is over here, not over here. So they're going 2016, 2017, not 2016, 2017 like that. So they increased their inventories by $1.4 billion. And so that was from here to here. So they spent in 2016 $815 million, and they got a 1.8 increase in inventories. And so there's a possibility that they also create inventory just from their factories. And maybe that's free, right? Net wholesale and other receivables. There is probably a way to add these. This might be it here. Let's just check. 836 plus 959, that's 1.795 billion. And then here, we want to look at 10,277 minus. No, it's not quite it. Okay, well, when I say free, I don't mean it in the literal sense. It's going to come from somewhere, but there's a possibility that they're not buying all of their inventories and possibly producing some of them. So, and then, accounts receivable, that's like basically sales that they booked, but they haven't necessarily they haven't necessarily received the cash, or sometimes they have. So that's going to be kind of wild to wrap your head around sometimes, because you're looking at multiple years and different products and different income streams might have different time periods between booking it as income or revenue and booking it as actual cash in the bank account. So try not to get too crazy about it, but basically you should be able to see these changes in working capital. That's what this is known as, like current assets outside of cash and marketable securities is known as working capital. That's how I like to define it anyway. And again, when you get down, this is a big reason why I love to use the metrics I use and not the real intricate detail line by line metrics, is because, notice what I said there, the way I like to define working capital. If you Google right now and you look at working capital, you're going to get a bunch of different definitions for it. And so, and remember, in some of these more intricate line items, they're going to call stuff different things, like financial service finance receivables. Why don't they just say account receivables? And then they break up the receivables into trade and other receivables. Like, that doesn't make sense to me. Why are they doing that? But, they don't have to be, they can categorize their little categories as much as they want, but the main ones, assets, liabilities, equity, those are always there. Every company has to report that, no matter how they categorize the little stuff. Earnings, revenue, dividends, right? Those are all stuff every company has to do. So that's why I analyze on those basic metrics. That's why when I talk about in the ebook that I have that's free, the 7 steps to understanding the stock market, you go to stockmarketpdf.com to get that one. Every single metric I use is one that's a major metric, and it does cover everything: cash flow, balance sheet, net income. Net income's right here in the cash flow statement. It's also in the income statement. That's why I do that. That's why when I use the value trap indicator, it sourced off the 7 steps understanding the stock market. Is because we want everything to be consistent, because companies can, not like they're playing tricks on purpose, but the way they categorize stuff might be different from company to company. So you have to keep that in mind. So long tangent aside, a little bit of a mini rant. Working capital, that's going to be found here, and they're reporting how it changes from year to year. And so that's going to change what the balance is. And so they have to report so that you can figure out, well, why did the cash balance in 2016 go from 15.9 to 18.4? Well, this is why. And so working capital is total current assets and current liabilities and how that changes. So keep that in mind. Now, next major thing, investing activities. This is going to be, so a lot of this stuff's like what's going on in the income statement, what's going on with the core business, how they're dealing with revenues, profits, and all those, and expenses and all those sorts of things. Now we get into like investing and financing activities. That starts to talk about what is a company doing after they're done with their profits. How are they going to distribute their profits? Because, the income statement tells us what the profits are. But, a company could be bad at allocating their what's called retained profits. But, what are they going to do with their profits? So what can the business do with their profits? Let's think about it. They can pay out a dividend. That's what they do. I like when they do that. They can buy back shares, which basically drives shares outstanding down, pushes share price up. Basically creates value for shareholders, because now you're owning the single share you own is now worth, it now owns a bigger percentage of the business. That's generally a good thing to see, but if a stock price is overvalued, I don't like to see stock buybacks. And the third thing that they can do with profits, well, okay, and there's a fourth thing too, right? The third thing they can do with profits is they can reinvest it back into the business. In the case of Ford, they could build 3 new factories, right? They can do that with their profits. And that should grow the business over the long term and hopefully increase the stock price, right? And the fourth thing they can do is they can just have the cash sit there. And that's where, if they're having the cash sit there, then basically what's going on with the cash flows is, and that's what they did with some of this, right? This line here, you can see the increase or decrease in cash and cash equivalents. Cash and cash equivalents is talking about what I said with that checking account that they have at the bank and what the balance is. So it looks like they've been adding to their cash just a little bit, which is good. It's good to have some cash. Just adding a little bit every year. One last note on cash and cash equivalents. You also can find that in the balance sheet. So if you go here, first line, cash and cash equivalents, 18,492. You can see 18,492. This is how much they have at the end of the year. That's the bank balance. Important point, by the way, spoiler alert. I'm going to cover at the end why that's so important, especially for me. All right, so some things that they can do from an investing standpoint with their retained earnings. Capital spending. Now, this is, they call it capital spending, but most corporations, businesses call it CapEx, capital expenditures. Basically, the idea is that's the money that you are spending to... There's 2 types of capital expenditures. I'm really glad I did the Warren Buffett video because it refreshed my mind about capital expenditures. So there's two types. There's maintenance capital expenditures, and then there's what's the second type called? Basically, you think like forward-looking capital expenditures and maintenance capital expenditures. So maintenance capital expenditures would be like, oh, well, let's say, I don't know, what's an example? Let's say inside the factory we have to buy. I don't know how factories work, guys. So just as examples, let's say they have to buy a million batteries, a million AA batteries to make this one machine run. Anyway, that would be a capital expenditure, but that'd be a maintenance capital expenditure because they need to make that expense in order to maintain the same production levels and the same operating business. Now, the other type of capital expenditure would be like what I said previously, where we say something like, let's build 3 more factories this year. So that's a capital expenditure. And so obviously, should be obvious, right, that it's gonna cost some cash to make that stuff happen. So that's why you see the parentheses are debits. Those are negatives. That's what we're taking out. That's less cash in our pockets. So that's where that comes. They can also do acquisitions, right? They can buy stock securities. So Warren Buffett does this a lot, right? He buys stocks of businesses, and because it's an insurance company, that's kind of the business model for insurance companies is they have float and they use that to buy shares in businesses. They can buy businesses outright. They can also buy common stock like we do as average investors. And so you'll see a lot of the stuff balances out. What's a negative here will be a positive somewhere else and vice versa. So like in the example of buying securities, 27,567, that's going to add to their marketable securities amount. And they have a bunch of notes in the footnotes, so if you're doing like an in-depth analysis, it probably helps to know what's exactly going on. But marketable securities counts as a current asset, and that's going to be they're just adding to their balance sheet, really, because you can buy marketable securities and you're adding to your balance sheet, you're adding to your assets, and those you can sell them later to create cash. You can get dividend streams from them, and that's going to give you cash, and add us cash, give us cash, make that bank balance higher. So, obviously it looks like they're buying some of that every year, as companies do. And see, look, here's the other thing. Here's where they're selling some securities. So maybe they're managing portfolios, right? Maybe they see, oh, well, this stock's kind of overvalued. Let's get rid of it. So that's kind of there. So there's going to be differences. And then at the end of each of these sections is going to be the net cash investing, operating, and financing. So bottom line is just everything that they're doing in the investing section, which again, they're either investing in their future, investing in other companies' futures, or they could be backtracking too, which isn't necessarily terrible. But anyway, like that's what's going on. What I mean by that, if they're backtracking, it's not necessarily terrible. Let's say that they've figured out that buying new factories is not efficient. It's not going to give them. They have such a dominance in the market, or they have such an oversupply in cars that building new factories is not going to give them any more income stream. So then maybe it doesn't make sense to invest in their own business or in other businesses, but then actually to give it back to shareholders. So that's where financing activities can come in. So they're going to pay cash dividends to shareholders. That's where this is. They can repurchase their stock. That's where this is. And changes in debt. So I guess they kind of lump in the whole what's going on in their with their debt, with the leverage, right? With what's going on in the balance sheet. So while this kind of focus more on like some of the asset side, looks like this is looking at more of the liability side. But some of that can change as well, and so they're going to put that in the financing activities. So that's something to keep in mind, right? Basically, investing activities, financing activities, if they're negative or positive, it's not necessarily bad indicator. Well, here's the financing things. That's the line I was looking for earlier. It's not necessarily bad to be one way or the other. It could be just case by case basis, but something to keep in mind as well. And so that brings us down to now we have the three: operating, investing, financing. We understand why operating isn't as straightforward as just the income statement. And we understand why this cash flow statement's relevant, why we need it, is because we want the bank balance. And so that leads us with the combination of the three. And then that difference is going to be the difference between our balance last year and our balance this year. Now let's make some practical applications to this, in the sense of, okay, well, you can use the cash flow statement like I did in the video yesterday to calculate owner's earnings, and that's very, very helpful. Owner's earnings can give you a better sense of how the operating business is really doing from a profitability standpoint. The other way, and this is the primary way that I use a cash flow statement, is when I'm using the value chart indicator. Remember, I'm using the basic metrics, right? I want to make sure when I buy a business, the value chart indicator works like a tripwire. Think like a security system with a bunch of lasers. Is that a good example? Let's run with it. So I just don't want, like, if there's like a laser line, I don't want any one metric to go above it. I want all the metrics to be decent enough, because I did bankruptcy research. I saw that all it took was one bad metric, and that could wipe a company out. They could have a great income statement, but have way too much debt. So that one single bad metric of debt wiped them out, regardless of how much cash they had, how many profits they were bringing in, how much revenue they had. So much growth was going on. And that was Lehman Brothers. So that's just one example. And there were a couple other ones too, outside of just like company has negative earnings and can go bankrupt, which is a more obvious situation, which obviously you want to avoid as well. So based on that, right, I want to make sure I have enough revenue when I buy a business, when I buy a stock. I want to have enough revenue. I want to have enough earnings. I want to have enough assets. I don't want too many liabilities. And I want to make sure I have enough book value. I have enough shareholders' equity. And what's the cash flow statement? I want to make sure I have enough cash. And so, kind of maybe non-intuitive, but all this stuff to me doesn't matter. I just, at the end of the day, want to make sure I have enough cash balance in the bank. And why does that matter? It's because, let's say that this is super low, right? Right now it's not like, well, they had a really good price to cash, right? But let's say they only had, like 100 million in cash instead of 18 billion. Well, let's say in 2018, one of our factories catches in fire, right? So we need to do like a maintenance type of CapEx in order to, either we spent a bunch of money to replace components, or we had to replace the whole factory, whatever. And so a couple options we'll have is A, not replace it, right? And watch our profitability tank as we don't have enough inventory to fill orders, right? We can't sell as many cars. Be like, sorry, can't sell you that car. That could happen. Or B, we could have used cash to repair the components. And so even though our cash would go down, investing activities, we'd have a big bump up in CapEx, but our profits would be able to stay consistent because we used cash in the bank to get rid of this horrible thing that happened to our business. Or the other option, if we don't have enough cash, is we could take out more debt, more loans, and really hurt the balance sheet, the big picture overall health of the balance sheet, just to get through a tough time. Or, maybe the fire thing was like an extreme example, but a better example is like when demand falls. And that happens you could probably argue that would happen for any business over the life of it. When demand falls or the economy contracts, it's the same type of concept. Are you going to have enough cash in the bank to support smaller profitability, smaller levels of earnings and revenues and all those sorts of things without getting into debt and or doing the opposite of buying back stock, which is now doing what Tesla loves to do, which is dilute their shares and hold stock offerings and try to raise cash by making your shareholders more diluted and having less percentage ownership in the business because they're adding to the common shares outstanding. So keeping that all in mind and understanding that if I want to go in and I want to check owner's earnings, or I want to check if they're doing a good job doing investing activities or financing activities, if the depreciation looks, if I want to look at how the depreciation and like owner's earnings can kind of maybe be a little bit different from what the income statement's showing, all those sorts of things are things that I can do and take on a case-by-case basis, because like I said, everything inside the sub points are all case-by-case. That's something I can definitely do. But when it comes to like using the value trap indicator, figuring out if a company's a value trap or not, come like big picture analysis, you want to use what every company holds consistent, and that's going to be cash in their balance. And so I've described why that's important. And so basically it's real simple. The way that I'll calculate a price to cash ratio is I want to look at net cash. And then let's say shares outstanding. Let's do it this way just to make it super simple. Price divided by cash, right? Means price divided by cash, which means, I don't know why my number key is not working. That's really strange. One of these days, I'm going to get like a regular keyboard rather than using my laptop keyboard. And all of a sudden, you guys will be like, wow, you got so much better at Excel. I'm going to be like, nope. It's because my laptop keyboard is crap. So I'm assuming if you've gotten this far in the video, you probably know what market cap means. Otherwise, you've been way, way lost, right? So I just want to calculate those, and I'm going to use shares outstanding and share price to calculate market cap, and then from there, net cash, and then that's going to give us our price to cash ratio. Price divided by cash, just like price divided by earnings. All right, so net cash, and this is huge. Net cash, remember I said earlier about sometimes when you're talking about some of the metrics, people will define it differently. Actually, the way I define net cash, it's a bit, I want to say controversial, but it's a bit different than other people. So keep that in mind when you see like price to cash ratios online. If they're not using the same metric that you use, if you're choosing to follow me and use the same metric I'm using, it's going to make make that price to cash calculation different. So the way Investopedia talked about it is total cash minus total liabilities. So they're talking about cash flow. That's not what I want, right? Like they can start to get into the cash flow statements and talk. They're talking about liquidity. They're talking about I don't even know what the whole point is at. Okay, because they're saying negative cash flow doesn't mean that a company can't pay all of its obligations. I don't care about that, because what I want is the cash on hand, right? And a company could sell, if they have enough assets, they could sell to cover. They could sell some of those assets to cover total liabilities. So that's not necessarily super important, and it doesn't really take into consideration, how are the changes in when we talk about like demand or economy retracting. right? So like if we did like a price to cash ratio, see, you Google price to cash, which is supposed to be P divided by C, and then you start to get P divided by CF, and nobody's talking about price to cash like I talk about. They're talking about this price to cash flow thing. So actually, when I first started out in 2013, there was more of a usage of price of PC rather than P to CF. So it looks like the internet's changing, right? People are using more of this P to CF, this net cash thing. So there's no debate anymore. It looks like everybody's using this implementation basically. So let's see what they say about calculating it, right? Now they're talking about dividing the company's market cap. So that's what we're doing, right? Operating cash flow. Remember now they're talking about this operating cash flow. Which again, that doesn't make sense. I mean, does that make sense to you? Like, we showed that, okay, well, what if a company paid out a ton in dividends? Well, they're going to have less cash in the books, but that's not going to show up in the operating activities. So how is the fact that they have, what if they're being stupid and buying back stock when the stock's super overvalued and they're not leaving enough cash in the books to weather a storm? They're just being very aggressive. Maybe the CEO's retiring in 6 months, so he just wants to bump the share price up, buy back a bunch of stock. Investors will look at it on the surface, be like, hey, that's great, let's jump in. And, he doesn't care about the long term because in 6 months he's out. So that's why I don't like this price to cash flow thing. I want to see if somebody else defines it in a different way when they talk about cash flow per share. Yeah, operating cash flow again. See, I don't like that. And so that should be obvious to us. And I'm sure, if I were to talk to the people who wrote those articles, they would say, well, this isn't, obviously you want to use other metrics to figure out how a company's liquidity can survive a downturn. It's like, no, I don't want other metrics. I want this metric. I want the metric. All I care about when it comes to cash is what's going on with the bank balance. Can we weather next year's storm? Regardless of what that looks like. And so at the end of the day, we're going to know how much cash we have. And so, even though we have a great core business, a CEO or board of directors, they could all be idiots. And that's still definitely a big possibility. And that doesn't save us. A great core business doesn't save us if they're making bad decisions on the back end with our earnings and things of that nature. So that's why I use, when I say net cash, and I say that all throughout my videos, my podcast episodes, my blog, that's what I mean when I say net cash. So make sure you know that. And so the way I do it, and it's no coincidence to me that how they report it on the balance sheet, cash and cash equivalents, 18,492, is how we're reporting it here with cash and cash equivalents, 18,492. So that's what I'm going to use to figure out if there's enough cash in the bank, price to cash, right? And that's going to automatically take care of a lot of the difficulties and intricacies of the cash flow statement without having to go too in depth. And then you can go case by case to really nuts and bolts it if you want. But chances are, if we've got enough cash in the bank account, we've got great profits. If we got great profits and enough cash in the bank account, well, they're probably doing a decent job at all the other stuff, which is buying back shares, investing, financing, stuff like that. And I say probably because it's a good generalization. Obviously, you always want to do deeper research as much as you can. That's where Warren Buffett's owner earnings comes in, because he does a good job of figuring that out. Owner's earnings gives you a great sense of it's so weird. I don't know why I can't use the arrows. it really gives you a great sense of like the true earning power of the business versus what they're reporting in the income statement, and like the capital efficiency of the business. And so there's other metrics you can use when you want to figure out specificities. Is that the word? I don't know. Diluted shares 2017 39.98. If you want to know about shares outstanding and diluted shares and why I use that over other metrics, then check out the first, I believe it was the first video of this tutorial series. Talked about EPS growth and shares outstanding. So this is 1133. Yeah, this keyboard's awful. So market cap's just going to be this guy times that guy. And there we go. We have a price to cash. 2.45. That's crazy low. It's a really great position, and it kind of makes sense. You look at their market cap's 43, and then their net cash is what do we calculate? Okay, we calculate 45. But anyway, you know, they just have a ton of cash. 18 billion in cash. It's almost half of what so you buy Ford right now, you're almost getting half amount of cash than what you're paying for. It's quite insane. Obviously you want to look at the other metrics and make sure everything's still looking good. Like, you know, are there reasons why there's so much cash, and is that a good or bad thing? That's why you always want the complete picture when it comes to this stuff. So I think that's going to wrap it up. I'm approaching an hour here. So wow, that was quite in depth, but you know, the cash flow statement's not really something to sneeze at. It's pretty complicated. You might still be scratching your head. I know I was. Really, it took me a lot of just thinking about it. And maybe, you know, a great way to learn too is trying to calculate other sorts of metrics that use the cash flow statement, and you might start to understand. And just don't give up, you know. I know it doesn't come as simple as like assets or balance sheet, but pretty soon it'll start to all align. And like I said, in the big picture grand scheme, I mean, yeah, you can use some of the other metrics in there to, you know, give yourself kind of like a competitive edge, or find value that other people won't be able to find because they don't know how to do that, or they just weren't looking. But, you know, from a general standpoint, you just want to make sure that there is enough cash in the bank, that we have enough earnings, that we're making good sales, and that we have a sound balance sheet. And that's really what it comes down to. That's what the value trap indicator is all about. If that's something you're really interested in, either get the free ebook I have, or buy the value trap indicator book, or both. But basically, before I sign out, my 3 recommendations, your 3 options that you can take from here. Subscribe to the channel, number 1. Click on the bell to get notifications. I'm going to wrap this series up next week with one more 10K tutorial. It's going to be a good one, so make sure you are subscribed for that, and you can be able to watch it once it comes out. Option number 2, subscribe to the email list over at stockmarketpdf.com. You'll get the free ebook that I'm talking about, 7 Steps to Understanding the Stock Market. You're also going to get daily tips from me, and it's just really help you and keep you plugged in and keep you updated, and give you these valuable lessons that over time, you know, you don't run a marathon and you don't sprint a marathon. You take little baby steps, or, you know, you build a wall and you go brick by brick. You don't try to knock it out in a 2-hour period. Option number 3, check out the playlist I created on the channel. It's called How to Analyze a Stock Using Valuations. It's a very, very helpful resource. It might help you cement some of the stuff that I covered, and kind of more go in depth into some of the other metrics, like the balance sheet and income statement. I tried to show some historical examples of where those metrics did well for investors and where they didn't, and how they were able to signal certain things. So that could be very helpful, and it's a good refresher review on some beginning concepts as well. I'm sure I'll be adding to the playlist in the future, so we'll see how that takes a life of its own. Bottom line is this. Stop working for money, put money to work for you. I will talk to you next time. Peace.